When someone buys a home using an FHA loan, most people expect the same thing, the minimum 3.5% down payment. But there's a specific rule inside the FHA program that can change that number overnight depending who you're buying that home from. It's called an identity of interest transaction, and it affects thousands of buyers every year, especially people buying from family, buying from their landlord, or buying from someone they already know. And if a transaction falls into this category, FHA normally requires a much larger down payment, 15% instead of 3.5%. But most people don't realize there are exceptions that allow buyers to still use maximum FHA financing. Even when the buyer and seller know each other. In this video, I'm going to break down exactly what FHA means by identity of interest, when the 85% LTV rule applies, the exact situations where you can still put 3.5% down, what documentation FHA needs to approve those exceptions, and examples so that you can see how the rule works in real life. Everything here comes directly from the FHA handbook and is accurate as of 2025. So let's start with the basics. In everyday terms, an identity of interest sale happens when the buyer and seller already have a relationship outside of the home purchase. Inside the FHA rulebook, that includes family members, landlord and tenant, employer and employee, the sale of business between partners, or any relationship where the seller could influence the price or terms to benefit the buyer. FHA treats these transactions differently because there's a higher chance the price might be adjusted, discounted, or set for reasons outside of normal market conditions. This doesn't mean this transaction is suspicious or improper. It simply means the FHA requires extra guardrails to protect both the loan program and the borrower. And the biggest guardrail is the loan-to-value requirement. In an identity of interest purchase, FHA restricts the maximum loan to value to 85%. That's another way of saying the buyer must put 15% down. FHA does this because when people with pre-existing relationships buy from one another, the agency wants to make sure the home value is sold and that the transaction is arm's length in terms of pricing. This 85% rule applies automatically when the sale meets the definition, unless it qualifies for one of FHA's exceptions. And that brings us to the part most buyers don't know about. The FHA handbook lists a few very specific cases where the 85% rule can be waived. And these are situations where the maximum FHA financing of 96.5% LTV is still allowed. So let's walk through each one clearly. You can still get a 3.5% down if A, you're buying the current primary residence of a family member, or B, you're buying a property owned by a family member where you have been a tenant for at least 6 months before the contract date. The definition of family member includes parents and children, siblings, aunts and uncles, step-family, and in-laws. If you lived in the home prior to purchase, FHA requires a lease or other written evidence showing you occupied the property for at least 6 months. This is important. FHA does not require a formal lease. Bank statements, pay stubs, W-2s, or a renter's insurance policy with a property address can qualify as other written evidence. This exception is one of the most commonly used. So if you're an employee of a builder and not related to the builder, and you're buying one of that builder's newly constructed homes as your primary residence, you can still use maximum financing. FHA counts this as an identity of interest, but it does not require the 15% down payment in this scenario. If an employer relocates an employee, buys their original home, and then sells that home to another employee, FHA allows maximum financing. These corporate transfer chains are fairly common with large companies that maintain relocation programs. So a tenant buying a home from their landlord can still use a 3.5% down payment if the tenant has lived in the home for at least 6 months before signing the sales contract, and the buyer provides a lease or written evidence of occupancy. Just like the family member rule, FHA accepts other written documentation beyond a lease, such as bank statements, pay stubs with an address, utility bills, renter insurance, or similar paperwork. So without proof of 6 months of occupancy, FHA will revert back to the 85% LTV rule. This is where a lot of buyers worry unnecessarily. FHA gives flexibility here. So examples of acceptable documentation include bank statements showing the address, pay stubs or W-2s with the address, renter's insurance declaration, insurance bills, utility bills, mail from official institution, a signed lease if available. The key requirement is that the documentation clearly shows that you lived at the property for at least 6 months before the contract date. That is it. Let's look at a few scenarios so you can see how the rule actually plays out. So let's say Jasmine wants to buy her parents' home. It's their primary residence. Even though this is a family transaction, FHA allows 96.5% financing with 3.5% down, and they do not require a 15% down payment. This one is very straightforward. So let's say Jordan is buying a condo from his sister. He's never lived there and it's not her primary residence. This is still a family transaction. But because Jordan wasn't a tenant for 6 months and because it's not the seller's primary residence, they'll require an 85% loan to value with 15% down payment. So let's say Maria has rented a home for 18 months and wants to buy it. Even though this is a landlord-tenant relationship, FHA allows 96.5% financing because the 6-month occupancy rule is met. All she has to do is submit 6 months of bank statements, her driver's license with the address, and a renter's insurance policy, and she is all set. This qualifies as other written evidence. So this is a very common question. A tenant has lived in the property for 2 years but has never had a formal lease. As long as they can provide documentation showing occupancy, FHA will still allow maximum financing. So the absence of a lease does not force the buyer into the 15% down payment. The documentation is what matters. A company relocates one employee, buys their home, and sells it to another employee. Even though it's an identity of interest, FHA still allows 3.5% down with a 96.5% LTV financing. There are a few common misconceptions worth clearing up. Myth 1. All family sales require 15% down. False. Multiple family scenarios qualify for maximum financing. Myth 2. If you don't have a lease, you don't qualify. False. FHA explicitly allows other written evidence. Myth 3. Buying from your landlord always triggers the 85% rule. False. 6 months of occupancy removes the restriction. Myth 4. This is a lender rule, not an FHA rule. Also false. This is direct from the FHA policy in the handbook 4000.1. Myth 5, identity of interest means something is wrong with the transaction. Not at all. It simply means FHA wants to verify the purchase price and financing are appropriate. These rules aren't meant to make buying harder. They exist to prevent inflated sales prices, which protects buyers from being pushed into purchases. It maintains fairness in the FHA program, ensuring homes meet true market value. And they also protect buyers who are purchasing legitimately from people they already know. The exceptions are designed so buyers aren't penalized just because the seller happens to be a family member or their landlord. Knowing how identity of interest rules work help buyers plan ahead. It affects your required down payment, how much documentation you need, whether you can qualify today or whether you need to wait until the 6-month rule is met. Buyers who understand the rule often find they can still use 3.5% down. They just need the correct documentation. So if you're planning on buying a home from a family member or from your landlord, or you're just unsure whether your purchase counts as an identity of interest, understanding these rules early can save you a lot of stress. So if you want more clear, relatable explanations for FHA rules, home financing, and the things that actually affect your loan approval, make sure to hit that subscribe button. My goal is to give you accurate information you can use to make informed, confident decisions and win with Wade.